Thanks everyone for joining us today. As Julia said, I am John Levis. I'm manager of the Health and Welfare Service team here at Sentinel, and I'm joined by my colleague, Kat Torres. She's one of our Health and Welfare account managers. Kat's going to be helping me present and facilitate today. And today we'll be doing an overview of plan rules and regulations as they relate to FSA, HRA, and HSA plans. Compliance can be a tricky business in normal times. We all know that. On top of that, over the last few years, we've seen a number of rule changes in response to the pandemic, both temporary and permanent. So as we hopefully transition into a post-pandemic world, we thought this would be a good time to refresh everyone on some compliance basics for these plans. This is not intended to be an advanced course in compliance, so some of the topics we cover may seem very basic, but that's the point. We want to hit the reset button, get back to basics, and review the compliance issues that plan sponsors face every day. So please feel free to add any questions you have to the Q&A, and we'll try to answer those throughout the presentation. And with that, Kat will start us off with a look back at some of that pandemic legislation.
Yeah, all right, buckle up. We are going to dive right into the fun stuff, which is COVID legislation. So early on in the pandemic, in an effort to provide some relief for Americans, there was a flurry of legislation and guidance that impacted these plans. While it's been over a year since we've seen any new legislation, there are a number of pandemic-prompted changes that are still impacting these accounts and need to be considered. The first legislation we saw early in 2020 was the CARES Act. Part of that relief effort made changes to IRS Code 213D, which governs eligible expenses for FSA, HSA, and HRA. Specifically, the CARES Act made over-the-counter drugs eligible without a prescription, something that had not been possible since the introduction of the Affordable Care Act. Things like Tylenol, allergy meds, and cold medicine can now be purchased with FSA or HSA funds. The CARES Act also made menstrual care products an eligible expense for the first time. IRS announcement 2021-7 made PPE an eligible medical expense as well. It is important to note that there was no time limit on these changes, so these expenses will remain eligible indefinitely unless another act is introduced in the future. Also in 2020, the IRS released Notice 2020-33. This increased the carryover from 500 to 550. The carryover limit is now indexed at 20% of the medical FSA annual election limit, so it will increase as the election limit does. The carryover limit for 2022 is currently at $570. This change did require you to amend your plan in order to take advantage of the increased limit, even if you're already offering the IRS maximum 500 rollover at the time. If you did not amend your plan and you would like to allow higher carryover amount, please contact your Sentinel account manager. The early days of the pandemic also brought us the joint notice or final rule, which is not permanent but still impacting plans today. The rule automatically extended the claim filing deadline for all medical plans, which includes medical FSA, limited purpose FSA, and HRA. Under this rule, plan participants have up to an additional year to file claims. It's important to note that this did not extend the period to incur eligible expenses, just the claim filing period. So we are still feeling the effects of this rule because it does not expire until 60 days following the end of the national emergency, which has not yet been declared. So let me give you an example. Say you have a 2021 plan that just ended on 12/31/2021 with a 90-day run-out period. Claim filing would have ended 3/31/2022. Because the national emergency is still in effect, the deadline is extended up to 1 year. Were the national emergency declared over today, the regular 90-day period would resume in 60 days, and the new filing deadline would be around 12/19/2022. If the national emergency is not declared over by the end of 2022, the filing deadline would extend to the maximum 1 year period of 3/31/2023. There's a lot of dates to keep track of with this rule, and we have no way of knowing when the national emergency will be declared over so there's no end in sight on this one. The national emergency has a sunset date of February 2023. However, it can be extended as it already has been several times. The bottom line is, until the national emergency is over, claim filing deadlines are extended up to 1 year. As a result, keep in mind that plans cannot be reconciled to determine forfeitures for an additional year. So if you're expecting some forfeiture funds back from Sentinel, know that we are just now at a point where we can reconcile 2020 plans because those claim filing deadlines were extended into 2022. And finally, just at the end of 2020 came the passage of the Consolidated Appropriations Act. That bill had a number of provisions, but the only one that we are still impacted is grace period extension and full carryover for the 2021 plan years. For the plan year that ended in 2021, you could choose to extend your grace period to allow up to 1 year following the original plan year end for incurring additional expenses. So if your plan year ended 12/31/2021, you may still be in the grace period for that plan through 12/31/2022 if you elected that full extension. The AA also allowed full carryover of remaining FSA balances for both healthcare and dependent care from the plan years ending 2021 to the following plan year. So participants may have significant balances to use through 2022. The grace period extension and full carryover were both optional and required a plan amendment to adopt. If you have any questions about what your plan adopted, feel free to contact your Sentinel account manager. So that's it for COVID-related changes. I'm going to turn it over to Jon to discuss plan docs.
Thanks, Kat. All right, so let's pivot away from pandemic talk and start to review the basics underlying these regulations that have been governing the plans for years. First up is your plan doc. Basically, without a plan document, you have no plan. So you must have a plan document drafted and adopted before benefits may begin. The plan document outlines all of the rules for your plan. Administration of the plan must follow those rules in order to remain compliant. There are also rules governing the distribution of SPDs to plan participants. Easiest way to meet those distribution requirements is to furnish a copy of the SPD at the time of enrollment to anyone who enrolls. You also want to make sure that you're distributing an updated SPD or a summary of material modification anytime there is a change to how your plan operates. So what must your plan documents include? First, a description of the benefits that are available and the participation rules, meaning any restrictions around who is eligible to participate and when they become eligible. The document should also outline the procedure for making an election and the rules around changing elections. That would include a list of qualifying events for making a mid-year election change. The document will include language on how contributions are made to the plan. For FSA and HSA, this is where the plan document would state that contributions are allowed through pre-tax payroll deduction and what the annual election limits are. Your plan year should also be stated in the plan docs. Plan years must be 12 months in length. That's unless you're operating a short plan year for the purposes of adjusting that 12-month period that your plan will normally operate on. For FSA plans, the plan document should include all of the other rules associated with your plan. So does your plan have a carryover? Is a grace period allowed? What's the runout period for filing claims? What happens when an employee terminates? What expenses are eligible? Is a debit card available? Everything the employee needs to know about how your plan operates and what the rules are should be included in your plan document. It is important that your plan follow all of the IRS regulations governing these types of accounts and all of those rules that are outlined in your plan document. If your plan is audited and found to be in violation, that could result in all of your plan participants losing the tax advantages that they gained from participation. That means all the pre-tax contributions made through the plan would become taxable, and the plan participants could end up with a hefty unexpected tax bill from the IRS. So let's look at some examples of what constitutes an operational failure. Some of these are things that employees will ask for flexibility on, so it's important to know that granting exceptions can put your plan at risk. Also note that these do not apply to HSA accounts. So first up is reimbursing expenses that are incurred outside of the coverage period. Your plan may only reimburse expenses that were incurred during the plan year the election was for and after the enrollment was effective. Any expenses outside the plan year are only allowed during a grace period. Second, failure to comply with the uniform coverage rule. That rule states that a participant in a health FSA or a limited purpose FSA is eligible for reimbursement of their full election amount, regardless of how much they have contributed. That's also the rule that prevents you from requiring or even asking terminated employees to contribute additional funds to cover the amount that they have been reimbursed. Next up is failure to comply with the use it or lose it rule. Any unused funds must be forfeited at the end of the plan year, with the exception of any allowable carryover. Also, failure to comply with grace period rules. The IRS allows for a 2.5-month grace period, no more than that. Allowing election changes without a qualifying event. This is a big one that employees will ask for flexibility on. FSA elections are irrevocable and may only be changed mid-year if the employee has a qualifying life event. Also, failing to comply with claim substantiation requirements. The IRS is very clear on what the plan needs to receive in order to process a claim, and any failure to collect all the required documentation and your plan is not compliant. So we'll cover more on claim requirements later on. Reimbursing ineligible expenses. The plan needs to be sure it's reimbursing only expenses that are eligible under the IRS guidelines. And then finally, allocating forfeitures other than as permitted in the regulations. The IRS outlines how the plan may be used, those forfeited funds, and we'll review that a little bit more later as well. So I will note that very little is actually reported to the IRS or any government agency regarding these plans. So many operational failures will go unnoticed. If any issues were to be discovered, it would generally be through a plan audit. And while that may be rare and unlikely to happen, it is still important to remain compliant in the event that that does occur. All right, so let's spend some time talking about eligibility guidelines for these plans. For FSA plans, the specific eligibility rules must be outlined in your plan document. There are certain individuals that are always ineligible to participate in a cafeteria plan according to IRS regulations. That list includes self-employed individuals, partners, more than 2% shareholders, outside directors, and members of LLCs. Individuals that fall into these categories are not eligible for pre-tax payroll deductions. And by the way, that also applies to HSA plans that offer payroll deductions through their Section 125 cafeteria plans. These individuals could be eligible for HSA, but shouldn't be funding them through pre-tax payroll deductions. So whose expenses can be reimbursed through a health FSA? They must be used to reimburse medical, dental, and vision expenses for the employee or their spouse. Note that in order for the spouse to be covered, they must be legally married, which does include same-sex marriage, and domestic partners are not eligible for FSA benefits. That's because FSA regulations are governed by the federal government and domestic partnerships are not recognized for tax benefit purposes. Expenses for an employee's children are eligible through age 26, thanks to the Affordable Care Act. That includes biological children, stepchildren, and adopted or foster children. And there are some other individuals that may qualify for FSA benefits, but that is less common and generally determined on a case-by-case basis. Those individuals would need to meet the definition of a qualifying relative, which involves some income, residency, and financial support requirements. Our other option for FSA is dependent care plan, which is most commonly used to cover daycare expenses for children 12 and under. Less common, but also eligible, is care for a spouse or dependent of any age who is physically or mentally incapable of self-care. Looks like we did have a question. If an employee is not enrolled in your medical plan, can they enroll in the healthcare FSA? The answer is yes. your FSA eligibility does not depend on enrollment in the medical plan. You can only make your FSA available to those who are eligible for your medical plan. Those are tied, but one does not have to be enrolled in the medical plan to participate in the health FSA. So let's look at HRA plans. These are fairly flexible and can be customized to fit an employer's needs. Through an HRA, you can choose to make benefits available to current employees, former employees, or retired employees. And you can cover expenses for the covered individual, their spouse, children, and other tax dependents. Eligibility for an HRA plan will depend on your plan design. Typically, an HRA is used to offset medical expenses not paid by insurance, and the eligibility will be tied to the medical plan. While some HRAs are very specific about covering only health plan deductibles, coinsurance, or copays, some plans choose to broaden the scope of eligible expenses and cover anything that is eligible through an FSA. Again, this is all dependent on your plan design. So if you have an HRA, it's important to follow your plan document regarding who and what is eligible. So now let's look at the eligibility rules for HSA accounts, which are very specific and can be a bit more complex. First and foremost, in order to be eligible to make HSA contributions, an individual must be enrolled in a high deductible health plan. For 2022, that's any plan deductible of at least $1,400 individual or $2,800 family. Second, you cannot contribute to an HSA if you can be claimed as a dependent on someone else's tax return. Third, and probably the part that causes the most confusion, is that you cannot have any other non-high deductible coverage. That includes health FSA, HRA, and Medicare coverage. If an individual or their spouse is enrolled in a full purpose health FSA, they are not eligible to make HSA contributions. Individuals are automatically covered by their spouse's FSA, and that can't be waived. So a spouse's enrollment does have an impact. Grace period and rollover may also impact eligibility. If your health plan or if your health FSA offers a grace period and an employee's balance has not reached zero on the last day of the plan year, then they will be considered covered by the FSA for the entire 2.5-month grace period and ineligible to make HSA contributions until the 3rd month following the end of the plan year. On the flip side, if your FSA plan offers a carryover, rollover funds in a health FSA from a prior plan year are considered health FSA coverage for the entire plan year that they've been rolled into. To solve for that, you can design your plan so that health FSA rollovers move into a limited purpose FSA when an employee is changing to an HSA. Limited purpose FSAs can cover dental and vision expenses only, and those are HSA compatible. Finally, enrollment in any part of Medicare will make someone ineligible since Medicare is health coverage without a high deductible. And in terms of using the account, HSA funds may be used to pay for expenses incurred by the account holder, their spouse, and any tax dependents. All right, so now that we've covered who can be covered by various types of plan, we'll dive a little deeper into FSA plans specifically and how they operate. So from the employee's perspective, their FSA experience all starts with their benefit election. And there are 3 times when an employee can make an election to participate in an FSA plan. That's when they're hired and fulfill the eligibility requirements, during your annual open enrollment period, or if they experience a qualifying life event outside of open enrollment. In general, all elections must be prospective in nature. That means that the election must be made before the coverage is effective. An employee can't make an election now and be reimbursed for expenses that occurred last month. Second, the election must be irrevocable. So no changes can be made to the election after the coverage effective date unless the employee experiences a qualifying event that allows a change. As you know, FSA elections are subject to an annual maximum This year, that's $2,850 for health FSA, which is determined per individual at each employer. So that means an employee and their spouse may both elect the annual maximum amount separately. It also means that an individual who changes jobs mid-year may elect the maximum amount through each separate employer. Dependent care maximums do work a bit differently. Those plans carry a maximum annual election of $5,000 per household. So spouses will want to coordinate their benefit elections to make sure they're not exceeding that $5,000 amount combined each year. Health FSA is also subject to the uniform coverage rule. That provides that a participant has access to their full election amount from the first day of coverage, and they're entitled to reimbursement of that full amount, regardless of how much they've contributed through payroll deductions. That's the risk that the employer takes on in offering these plans. On the flip side of that, the employee also takes on some risk by participating in a use it or lose it plan. So if they don't use the full amount that they've elected within the plan year, they forfeit any remaining balance, two exceptions being grace period or carryover. All right, that's it for that portion. I'm going to pass it to Kat.
All right, John, before I begin, do you want to take a look at some of the questions in the chat? We have one about HRA eligibility and 2% shareholders.
All right, so can 2% shareholders of a firm participate in HRAs? That's a great question. Specifically, the rules that we were referring to were cafeteria plan eligibility in terms of making pre-tax payroll deductions to these plans. So 2% shareholders would not be eligible for FSA or HSA pre-tax deductions. That does not specifically apply to HRA. Off the top of my head, I'm not sure about the HRA rules for 2% shareholders, but we can certainly check on that and follow up after this. Will we receive a copy of the presentation? Yes, we can make the slide deck available, and a copy of the recording will be available after as well. And then there was another question, do we have to offer the full $2,850 maximum annual election amount? You do not. So that's the maximum you can allow. You can set your plan to allow a lower limit than the full $2,850 for a health FSA, but that does need to be stated in your plan documents. Let's see, can a domestic partner participate in an HRA? I believe the answer to that is no. I believe they can participate in the underlying medical plan, just not on a pre-tax basis. So if your medical plan decides to offer medical insurance to a domestic partner, you can do that, but you're taxing those premiums to the employee. Since the HRA is fully pre-taxed, I do not believe that you can offer the domestic partner coverage through the HRA portion because you wouldn't be taxing those benefits. But that's another one that we can follow up after. Actually, that person sent in their question anonymously. So if you'd like to ask again without being anonymous, we can certainly follow up with you after the presentation. Finally, can an employee discontinue participation in FSA during the year without a qualifying event? Answer to that is no. Any changes at all, including stopping their participation, requires a qualifying event. So unless they're terminating employment, they would have to continue through the end of the year.
All right, thanks, John. All right, so before I begin, I will note that these next 5 slides truly cover day-to-day operations. These topics cover our most frequently asked questions. So as John mentioned, elections are irrevocable and may only be changed outside of open enrollment if the employee experiences a qualifying life event. The most common life events for the FSA are a change in the number of dependents through birth or adoption, change in marital status through marriage or divorce, and change in employment status of an employee or spouse that impacts their eligibility. We have some others listed here that are less common. I do want to point out that the QLE, change in cost of care, applies to dependent care only. The change in the cost of care qualifying event provides flexibility for changing dependent care elections mid-year. This is due to the fact that daycare needs can be unpredictable and change frequently. So if an employee has a situation where their daycare costs change mid-year or their need for childcare changes mid-year, they are allowed to make the change to their dependent care election. The change in cost applies to a new need for care, terminating a need for care, or just a change in cost of care. And finally, I'll point out that the IRS does require election changes to be consistent with the qualifying events that occurred. Essentially, all of the qualifying events listed are allowed because the event will likely result in some change in the amount of expenses that an individual can expect to incur. The change that is made must be consistent with the anticipated change in expenses. For example, if an employee is making a change because they had a baby, their election amount may be increased to account for adding an additional dependent, but it cannot be decreased. The IRS does allow for election changes or corrections when there is a clear evidence of a technical or administrative error. Those can be assessed with your account manager on a case-by-case basis. So a technical error would be someone that enrolls in dependent care but has no eligible dependent. An administrative error could be an employee that completed the form for medical coverage and the employer entered the dependent care coverage. Again, these should be assessed with your account manager as there are certain elements to consider to determine if correction is appropriate. All right, eligible expenses. The IRS defines those expenses, and it's the TPA's job as claim adjudicator to ensure that plans are only reimbursing for eligible expenses and remaining compliant with IRS regulations. Again, the IRS determines eligible expenses, and it's Sentinel's job to make sure your plan remains compliant. I know employees get frustrated with the claim process because they're asked for very specific receipts or additional information. Sometimes claims are denied and the employee thinks we're just being difficult. We'll touch on claims adjudication on the next slide. Ultimately, we're just trying to do what's needed to remain compliant and protect the tax-favored status of your plan. All right, now that we got that out of the way, eligible expenses now include over-the-counter medications. Expenses must meet the standard in order to be considered eligible. The IRS states that eligible expenses incurred for general health, like vitamins, or for cosmetic reasons are generally not eligible. If the eligibility of a specific treatment is in question, sometimes it's necessary to request a letter of medical necessity from a doctor in order to approve that claim. Keep in mind that the limited purpose FSA follows the same standards, but is restricted to dental and vision expenses in order to preserve HSA eligibility. And finally, dependent care. These accounts can be used to pay for care that is needed for a relative so that an employee can work, look for work, or go to school. The most common use here is for childcare. That could be daycare, after-school care, preschool, or day camp. As long as the expense is not educational in nature and the primary purpose is to provide care to a child age 12 or under, the expense should qualify. Less commonly used, but also eligible, is if an employee has an adult taxable dependent that relies on them for care. These accounts can be used to pay for care that is provided while the employee is working. Sentinel follows IRS guidelines in terms of what is required when filing a claim. So first off, a signed claim form or online claim form. Why? The claim form and on the online system have attestations required by the IRS to determine claim eligibility. Along with the claim form, we must also receive documentation supporting the claim. Supporting documents must include the Big Five, which is the name of the provider, name of the individual receiving service, date of service, description of service, and the amount charged. And according to the IRS, the Big Five is required to determine claim eligibility. For dependent care claims, we're also required to obtain tax ID number for the service provider. Substantiation. Now, this is vital. Substantiation falls under claim adjudication. You may hear your account manager use the term substantiation when you ask why someone's card is suspended. Also, according to the IRS, debit card transactions must also be substantiated to confirm eligibility. There are a couple of ways the IRS allows us to substantiate card claims without a receipt. One is through data obtained at point of sale through the credit card processing terminal. This allows us to approve the vast majority of the debit card transactions without additional documentation. The other method is through copay matching. So during OE, when we ask you for your copays, this is why. If the amount of the card swipe matches the copay amount associated with one of your insurance plans, we can consider that a substantiated claim. If you are unable to substantiate through one of those methods, then we are required to request additional receipts. The most common submissions to those requests are the thin credit card slip that you sign that is not sufficient. Remember that we need the big five for claim adjudication, and this applies to card transactions as well. So we'll often be asked how a debit card transaction was approved if ultimately it wasn't eligible. So let's say you go to the dentist and you get your teeth whitened. The initial card swipe for your payment will be approved because their card processing system is identifying as a dentist office. At the time of the swipe, that is the only information we see. The transaction does not identify what service was performed or if it was eligible. Once we review the transaction and aren't able to determine if a claim is eligible because we don't have enough information from the transaction, we will request receipt. If the receipt shows the service was ineligible, we need to request repayment of the claim. The IRS also instructs that if the claim is not repaid or deemed ineligible, we are required to suspend the debit card. Again, Sentinel is enforcing IRS rules in order to keep your plan compliant.
Kat, we've got a few questions that came in around eligibility of expenses and some qualifying event questions. We can go through those real quick. Are after-school activities like sports eligible for FSA?
As long as they are used so your employee can work.
Yeah, I would say more specifically, as long as the primary objective is care. So if your child is, playing baseball after school and there's a fee for that, that's not for their care. That's them participating in a sport. If they went to a baseball camp during the summer, a day camp, and they were going to that camp, because there was no school in the summer, and that allowed you to work, then that would qualify. But just paying for sports is not eligible because that's not primarily for the care of the child. Can you use your HSA for over-the-counter eligible expenses? Can you confirm?
Yes.
Easy answer. Save your receipts in case you're audited. Yes. That change applied to HSAs as well. So those are now eligible. Can you speak to when an employee should stop HSA deductions when they become Medicare eligible? I'll take that since I was covering eligibility. Medicare eligibility is not what prevents someone from making contributions to an HSA. It's anytime they've enrolled in any part of Medicare. They have to be careful about what happens in terms of when they elect to start receiving Social Security benefits and things like that, because receiving Social Security will often enroll you automatically in at least some part of Medicare. But if the employee is putting off that Social Security enrollment and putting off any type of enrollment in Medicare, then they can continue to make HSA contributions. So it's just once they're actually enrolled in Medicare, that's when they stop being eligible to contribute to their HSA. And I think one last one that I'm seeing here. Can you enroll a domestic partner onto a health insurance plan mid-year without documents showing the employee and their partner became domestic partners? What would qualify as proof of start of domestic partnerships? That's not an area of expertise for us, since FSA plans that we're discussing today don't cover domestic partners. That would be a question for your health insurer or your broker. They can let you know what the requirements are for documenting a domestic partner and adding those mid-year. Would aftercare at a day camp be eligible for dependent care? So say they pay $25 a week for care from 3 to 4 p.m. Yes, that would be eligible. Any after school care, as long as if your kids go to the YMCA in the afternoon after their school day, that is eligible under dependent care. Another question came in, does Medicare cause problems with an FSA? No, Medicare and FSA do not interact. So one does not affect the other. So you can be both participating in an FSA and participating in Medicare. I think that's it for questions. We're all caught up for now. So we can continue and we'll circle back for more questions later.
All right, so we are in the home stretch now, and we'll spend the last handful of slides covering a variety of miscellaneous topics on various plans. So let's talk briefly about terminated employees and how they should be handled for each plan. For health FSA, coverage ends on their termination date and services must be incurred while actively employed. Under the uniform coverage rule, participants cannot be asked to make up the difference between what they have spent and what they have contributed. Even if they offer, it is a violation to accept those funds. Employers may only withhold regularly scheduled deductions through the employee's final paycheck. FSA accounts are COBRA eligible benefits. COBRA continuation should be offered if the employee has not spent more than they contributed at the time of termination. Dependent care plans are treated differently in regards to termination. Participants may continue to incur additional expenses after they have terminated through the end of the plan year. This is due to the fact that dependent care only reimburses what the employee has contributed, and the expenses incurred while looking for work are eligible. Dependent care is not COBRA eligible, so there's no need to offer that in the COBRA package. HSA accounts are the most beneficial to terminated employees. They retain the full account balance, can continue to incur expenses, and make withdrawals from the account, and the account is portable. The terminated employees can transfer their Sentinel HSA to a new employer or another custodian. And lastly, HRA plans are considered medical coverage and therefore are COBRA eligible. HRA continuation through COBRA should be offered to all terminating employees that are participants in the plan while actively employed, just like your major medical plan. HRA continuation can be bundled and offered along with medical plan coverage, or it can be offered on its own as a separate election and premium. All right, a quick overview on plan forfeitures and healthcare FSAs. IRS provides guidelines on what you can do with the forfeitures if your plan year ends with a surplus. First and most commonly used option is to defray the administrative expenses of your plan. Essentially, the plan sponsor keeps the forfeited funds and treats it as reimbursement for the cost associated with the administering the plan. The last three are less commonly used, but still an option. The second option is to reduce required premiums for the following year. For FSA plans, that would mean using the forfeited funds to reduce the amount employees have to contribute through payroll deductions in order to get their desired FSA coverage amount. I've never seen any plan sponsor take that route because it involves complex calculations and adjustments in payroll. Third option is to increase the annual coverage amount in the following year. For FSA plans, this can be accomplished by allocating the forfeitures to participants in the following plan year as an employer contribution. The last option is to return the forfeited funds to participants in the form of cash. It is important to note that for option 2 through 4, where funding is being returned back to the employees in some form, the amounts the employees receive cannot be based on their own experience, meaning you can't just return the amount each individual forfeited back to them. That would violate the use or lose it principle of these plans. If you're using one of these options, the funds must be divided among all participants evenly or proportionally based on initial election amounts. Please note these ERISA rules do not apply to dependent care. And I will turn it over to Jon for the last 3 topics.
Okay, thanks, Kat. In these last 3 slides, we'll quickly cover just a few general items. First up is non-discrimination testing. Testing is required annually to ensure plans are not operating in favor of highly compensated employees. As you can see on the slide, there are a number of tests required that involve testing both the cafeteria plan as a whole and individual benefits within the plan. The plan must pass non-discrimination tests as of the last day of the plan year. So that means that testing should be done once the plan year is complete. You can complete projections testing throughout the year to determine if the plan is in danger of failing, and then have an opportunity to take corrective action. Projections testing is most often used for dependent care average benefits test, since that is the one that some plans often have difficulty passing. Once your testing is complete, there's no filing of the results with the IRS or any other government agency. The testing results should just be kept on file in the event the plan is audited. If an audit is performed and the plan is found to be discriminatory, then that would result in your highly compensated and key employees losing the tax benefit that they receive for participating in the plan. HRAs are also subject to some testing, but failures on those plans are rare, and they will generally pass provided that the HRA is available to a majority of employees, and if the benefit amount is uniform or based on health plan coverage level and not on other factors. ERISA also requires that some FSA and HRA plans file a Form 5500 annually. If your plan has fewer than 100 participants at the beginning of the plan year and the plan is unfunded, then the plan is exempt from that filing. Unfunded means that the benefits are paid from the company's general assets rather than a trust account for the plan. If you are required to file a 5500, then those filings are due 7 months from the end of your plan year. Finally, we'll end with a quick look at PCORI fees. PCORI stands for Patient-Centered Outcomes Research Institute, and this fee was originally introduced with the Affordable Care Act and is used to fund a nonprofit research institute in the US that is aimed at helping individuals make more informed decisions about their healthcare. The PCORI fee was due to expire a couple years ago, but that was extended and is currently in place through 2029. The fee applies to all self-insured medical plans, which includes HRA, and it's due by July 31st each year. That fee varies and it increases slightly every year. Filings due at the end of this month are for your plan years that ended in 2021. If you're a Sentinel HRA client, we will provide an annual report with the number of covered lives in your plan, and then you would file that fee on Form 720 with your quarterly federal excise tax payments. And that wraps up everything we had to review today. So we'll see if there are any lingering questions in the chat we haven't answered yet. And if any more come to mind, please feel free to pop those in now. Also, we'll ask if you have any suggestions for topics you'd like to see covered in a future webinar. Please feel free to add those to the chat as well, or email your Sentinel account manager afterwards. So one question.
Jon, we do have 2 questions.
Go for it.
Yep. So yes, a recording will be sent to everybody registered for this webinar. The other question is HSA subject to non-discrim testing? Is the dependent care FSA subject? The dependent care FSA is subject to non-discrim testing. The HSA is not.
Okay. I think that's all the questions so far. So if you have any other questions after the webinar, please feel free to contact your Sentinel account manager. You can also check out our online employer help center that can be found at employerhelp.sentinelgroup.com. And I think that's it. So thank you for joining. Keep an eye on your inbox for a recording of today's session. And have a great day. Thanks for joining, everyone.
Thank you.